Welcome to today's Explainer. We're jumping right into a massive debate surrounding a stock that has been absolutely on fire this past year. We're talking about Hewlett Packard Enterprise. You probably know them by their ticker, HPE. As an AI infrastructure darling, they've been dominating the headlines lately. But this massive run-up is leaving the market completely divided on what comes next.
Look at this, a staggering 130% year-to-date surge. That right there is the multi-billion-dollar question we're dissecting today. Is this incredible rally truly sustainable? Like, is it driven by a permanent structural shift in tech? Or are we just looking at a classic case of buy the rumor, sell the news? You know, a bubble that's stretched way too thin and ready to burst.
Okay, let's dive into this. Here's our roadmap for today's 360-degree impartial analysis. We'll cover the surge catalysts, Wall Street's bull case, the bearish reality check, technical chart outlook, and finally, key takeaways. Section 1. The surge catalysts. Let's look at the hard numbers driving this price action right now.
So first, we have to set the scene with the broader market. Just recently, HPE shares jumped a massive 8% in a single trading session. But get this, the initial spark actually didn't even come from HPE itself. It came from rival tech giant Lenovo. Lenovo posted a stunning 43% jump in quarterly revenue, riding the exact same AI infrastructure wave. And because they share similar supply chains and end-market demand profiles, Wall Street instantly took this blowout earnings report as a massive green light for the entire enterprise hardware space, pulling HPE right up with it.
But hey, HP isn't just riding Lenovo's coattails here. When you look at HP's own recent quarterly numbers, they completely smashed Wall Street's expectations. The consensus estimate sat at 54 cents per share, but the actual reality? A massive 79 cents in earnings per share.
The sheer scale of their current growth story is pretty remarkable. Total revenue hit $10.68 billion. That is a 40% jump year over year. And crucially, their AI server backlog is growing faster than they can even build the racks and fulfill the orders. To top it all off, their acquisition of Juniper Networks is really starting to pay off, with network revenue expected to grow nearly 75% this fiscal year. On paper, it's basically a textbook growth story.
Moving on to Section 2, Wall Street's bull case. Let's examine why institutional money is pouring into this stock.
Wall Street's biggest names are absolutely putting their money where their mouths are. Morgan Stanley recently upgraded HPE to overweight with a $69 price target, calling it a top pick for the enterprise infrastructure cycle. Goldman Sachs holds a buy rating with a $75 target, and Citi is even more bullish, setting their target at $79. The overall consensus across the street is a moderate buy, with an average target of $70, which implies about an 11% upside from current levels.
But you know, it's not just the analysts who are optimistic here. Institutional heavyweights are actively piling in and increasing their stakes. We're seeing major moves from Counterpoint mutual funds and Capital World investors. Even Elliott Investment Management, a firm notorious for its aggressive, targeted activist plays, has been buying in heavily. They clearly see HPE as one of the very few companies with the global scale and supply chain leverage to actually win the massive data center upgrade contracts happening right now.
A prominent portfolio manager recently summarized the bull thesis perfectly, saying, "This isn't a trade, this is a structural shift in corporate IT spending." The optimists don't just see a short-term blip. They're betting on a multi-year AI supercycle where every enterprise on the planet is forced to upgrade their capabilities. And HPE's CEO is backing this up by citing, quote, unprecedented demand. But let's flip the script. Section 3, the bearish reality check. Now, what's really interesting about this next slide is the valuation worries.
We absolutely have to address the elephant in the room, valuation. When a hardware company surges over 130% in a single year, it starts trading way above its historical valuation metrics. Some analysts argue HPE is now priced for absolute perfection, meaning any slight miss or negative headline could cause a heavy pullback. We literally just saw this play out when the stock dropped nearly 3% in a single session, mostly driven by profit-taking. It's exactly this kind of volatility that scares away risk-averse investors. Plus, there's a serious wall of worry when you look at the competition. HPE is not alone in this gold rush. Dell is a fierce head-to-head rival in AI servers. Supermicrocomputer is actually growing even faster in certain specific liquid cooling segments. And perhaps the biggest long-term threat? The hyperscalers themselves. Amazon, Google, and Microsoft are pouring billions into building their own custom silicon, which could eventually drastically cut middlemen hardware vendors like HPE entirely out of the loop.
Then there's the question of ultimate sustainability. While top-line revenue is booming, profit margins are facing very real threats from rising supply chain costs, particularly the soaring prices of memory chips. Furthermore, bears are pointing to the pull-forward effect. Like, are companies just hoarding AI servers right now out of FOMO and fear of future shortages? If so, we might be looking at a severe demand hangover by 2027 or 2028 once the initial panic buying subsides.
To perfectly balance our 360-degree view, contrast that earlier optimism with this stark warning from a bearish analyst. HPE is a great company, but it's not a 130% in a year company. The fundamentals don't support that kind of multiple. This highlights the core tension perfectly. Great execution, sure, but potentially dangerous market expectations.
All right, Section 4, Technical Chart Outlook. Let's ground this narrative in the cold, hard technicals and see what the price action is telling us.
Because the price action doesn't always match the fundamentals perfectly, technical traders are closely watching these specific levels. On the upside, HPE has been finding heavy resistance right around that $59 to $60 ceiling. If it breaks through on strong volume, the target becomes that $65 to $69 analyst range. Conversely, on the downside, the safety net or support is forming between $52 and $54. If it breaks below that, we could see a deeper correction, testing the 50-day moving average down at $48.
Looking at momentum, the RSI has been flirting heavily with overbought territory. Now, while that doesn't mean the rally is entirely over, it heavily suggests near-term consolidation or a pullback. The absolute crucial line in the sand for the bullish trend to remain intact, that would be holding the $56 level.
Let's bring it all together. Section 5. Key takeaways.
So the most crucial point here is understanding your own strategic mindset. If you're a long-term investor who believes AI infrastructure is the backbone of next-gen computing, HPE absolutely belongs on your radar, but expect heavy volatility. This isn't some sleepy dividend stock. You're going to need to watch patiently for reasonable entry points. On the flip side, if you're a short-term momentum trader, realize the risk-reward equation is getting a lot tighter. You have to actively manage your risk, watch those support levels closely, and maybe consider taking profits on aggressive spikes.
Regardless of your time frame, keep your eyes locked on 3 critical metrics. Number 1, AI server backlog growth. The second that slows, the stock will feel it. Number 2, memory chip costs, which are threatening to eat into those precious profit margins. And finally, you have to strictly track the custom silicon efforts of the hyperscalers and the ongoing pricing war with Dell. These will ultimately decide if the stock keeps climbing or falls back to earth.
HPE is a prime example of the AI era's massive promise, but also its inherent perils. They're executing brilliantly, but the margin for error at this valuation is razor thin, which leaves us with this final, provocative thought to consider. Is the AI supercycle already fully priced into this 130% surge? Stay disciplined out there, keep learning, and thank you so much for joining us for today's Explainer.